Are we seeing a return to 100% lending, no deposit lending on property? Well, maybe, maybe not. I'll go through that in this episode of UK Property Talk. My name is Charles Kelly. Now, in the past, before the last financial crisis, we had lenders lending regularly 100% mortgages, 125% by the Northern Rock, in fact, who would lend enough to buy the property, and then they would give you a loan on top to pay for any refurbishments or furniture, because they reasoned that people would go out and borrow this money anyway at higher rates. And it worked quite well for many years. But then there were also lenders doing sort of non-status self-certification mortgages where you certified your own income. So even if you didn't earn enough, you could say, I earn 100,000 a year, give me a mortgage for 400,000, and they would give it to you. Now this went wrong after 2008, but I don't think it was down just to that kind of lending. In fact, the Northern Rock didn't get into trouble over those mortgages. They got into trouble because they ventured into commercial loans, which they didn't understand, and they started making losses there. Other banks got into trouble because of this sort of derivative market of selling subprime loans packaged up as security, and it all went wrong, really starting on Wall Street. So that's where the financial crisis came about. And of course, then the government then had to bail out banks such as Lloyds and RBS, which owns NatWest. And then they tightened their lending. They said, no, you can't just keep, self-cert mortgages just ended at that point. So that's what happened then. And I always felt that it was a shame that it went wrong because of investment banking rather than ordinary lending, because the lending wasn't that bad. Admittedly, subprime lending was a bit difficult because if you had previous arrears or bankruptcy, or you had a load of county court judgments, you could get a subprime loan from a lender like Kensington, who would charge you something like 4% above the normal rate. I mean, it was horrendous rates, and they would pay huge commissions to the broker. So the people that could least afford it were paying the highest rates. Now, I know that the lender had more risk, but these subprime loans become a big market, and a lot of those went wrong as well, like lending money to people who couldn't afford the last loan. Doesn't seem like a good business model, although the lenders said once people have learned their lesson, they very rarely got into arrears or went bankrupt after that. So the vast majority of the actual loans were still being paid in the UK. I don't think there was a problem with self-cert. Buy-to-let was easy as well, 85%, no income checks. It was great, and now that's become more of a problem. Now they're looking at affordability more detail, and it's become more difficult to get mortgages. But things could be changing. There have been some new lenders coming around offering so-called 100% mortgages. Now, one lender has come on the market, Propertunity, I've never heard of them, coming onto the market offering 100% or no deposit mortgage. Well, it's not quite 100%, it's no deposit because they are the way they've structured it, but they haven't published any details. You can go to their website, propertunity.com, or you can find it, Propertunity, and I think they're asking people to register their interest in this scheme. But it looks like it's going to be a 90% mortgage from them plus a top-up loan of 10%. So if you bought a property, for instance, for £100,000, traditionally a lender might give you £90,000. So you would have, say, £10,000 to £15,000 of equity in the property. So if anything went wrong, you could sell that property, probably still make a profit, still pay the loan off. But these loans will be taking up all the equity with a top-up loan of the £10,000, interest only. It harks back to, I remember this years and years ago, they had top-up loans like this until the lenders started offering 100% mortgages. There were American lenders like Citibank that came in and smashed the market open with 100% loans. So then those top-up loans started to sort of disappear. But we don't know the details. Are these top-up loans going to be like the Help to Buy, where they're in effect taking an equity share in your property? Or will they just be a straightforward interest only that you pay off at some stage in the future? Do you have to make payments? How will it work? All I know is that, usually it's cheaper to buy than rent, and that's what pushes people into buying whatever the cost of the loan. And once you've bought your property, you feel more secure that you own that property. You're not going to be asked by a landlord to leave in 5 years' time because they're selling the property. So I understand that. Now, there are other schemes coming around I can see where they're saying we'll give you 10 times your income to buy a property, and minimal credit checks and that sort of thing. But looking into those in more detail, they seem to be some kind of rent to own kind of deal, where it's not a bad deal. It's the owner of the property selling you that property. You're paying rent and mortgage. It looks like it's kind of like a shared ownership. Of course, they do affordability checks, but it's much less stringent, I would have thought, than most lenders covered by the Bank of England. So it'd be interesting to see how that works. Just be careful. Always take financial advice before you do anything like this, and legal advice, because there are a lot of let's say unusual schemes around at the moment which are not standard mortgages. But I hope that more flexible lending does come back, because it's been very difficult for first-time buyers to get on the market, get on the property ladder with the way things have been going at the moment. And unless they've got parents or grandparents that can release equity on what's called an equity release scheme from their property to lend them a large deposit, they usually can't get on the property ladder at all. And remember that the bigger deposit you've got, the better deal you will get on mortgages. Now, getting on to the economy, inflation is now 9.4%. In fact, on the news, they put it a different way last night. They said, on one of the financial programs, they said people now buying £100 worth of shopping now, compared to last year, are paying, what was it? They're paying 10% more for that same bit of shopping, which is true, compared to not just last year, but even 6 months ago. So things are getting tough for a lot of people in the country. That's what I'm trying to say. Although we're not officially in recession, in fact, the economy grew in May by 0.5%. But other countries are going into recession, and Bank of England say that the inflation will peak at 11%, and that they heavily hinted that they're planning an interest rate rise of 0.5% this year. The European Central Bank have put up their rates by 0.5% for the first time in 11 years. The US Federal Reserve are more aggressively putting up rates, and that's strengthened the dollar, but it's weakened. Other currencies against the dollar have weakened. That's made life difficult for them when they need to pay for their imports in dollars, like oil. So a lot of countries around the world are suffering. There has been some good news on that there's been a deal between Russia and Ukraine to release some of this grain that was stuck in the Black Sea. So that might ease things. I hope it will, because a lot of people are going to go hungry. It's not just about prices in the shops for them. It's actually that there is no food and they could starve. So it is quite serious. And we've got public sector workers threatening strikes. They're not happy with a 5 or 6% or 7% pay rise. They're going on strike. They want 9 and 10%. So that's going to add to the inflationary pressures. And so we will have to see. We've got a change of government coming. Possibly Liz Truss will be the next Prime Minister. She has promised to ease the austerity measures a little bit, kind of defer the debt repayment plan, cut taxes, and maybe stimulate the economy. And that could be good for the country, I believe. I hope she does win against the other contender, which is Rishi Sunak. But mortgage rates have now gone up by 300%. About a year ago, they were roughly 1%. You could get a mortgage around 1%. Now it's 3 and 4%. So that's a big jump. And it means that people coming to the end of their fixed rate deal, a lot of people are on fixed rates, of course, about 75%. They're going to be subjected to affordability tests to see if they can afford this new fixed rate. Now, if they can't afford it, they're going to put them on a variable rate, which will be more expensive than the fixed rate. That doesn't make sense, does it? It's crazy, but that's the way these lenders with their tick boxes and that's the way they work. So I know that Martin Lewis is looking into this. He's trying to get a campaign on this, but Nevertheless, a lot of people are going to be paying a lot more for their mortgages in the next year or so. We could see more arrears, more repossessions. I don't know. I'm sorry not to be gloomy about this, but there's not much you can say when there's war, there's turmoil around the world, there's inflation we haven't seen for 40 years, and we've got even things like Bitcoin have crashed. The stock market is high. I think that's about to crash. Property prices are still going up, of course, but when you see a downturn in the economy, when I've lived through recessions and downturns, property always falls. But in inflationary times, when the economy is not going down, property still can go up in price. Like in the 70s, they were still going up. It went up enormously. So we will have to see. Right now, it's property prices are rising faster than inflation. Inflation is running at just under 10% a year. Property prices are running at around 13% rise per year, according to the June figures, where it still went up again. But I don't know how long that's going to last. We shall see. If this current financial squeeze goes on, I don't know what will happen. Obviously, people at the lower end of the scale, they're seeing their pay falling behind with the cost of living. This is not just in the last year, this is over decades. So people are suffering. But on the other hand, there are a lot of people with money and equity in their property, so they can release equity from their property to help people buy. And when I say equity release, I'm talking about people perhaps in their late 60s, 70s, up to 80s, who have a big property, no mortgage. They're perhaps going to pass it on to their children, then they'll pay inheritance tax, and they decide, well, why don't I release money from this property now to give to them so they can buy their property rather than waiting for me to die and then pay inheritance tax on it. Now, as long as they live for 7 more years after they've made the gift, no inheritance tax will be paid. It sort of tapers off over 7 years. So it's quite a good method of reducing inheritance tax. And the loan itself, the equity release loan, there are no repayments on it. It just rolls up, but it does roll up at high interest rates. It rolls up at 4 and 5%. So every sort of 15 years or so, that loan will double, but hopefully the property would have doubled anyway. But regardless of that, it's a good way of getting money to people who need it now rather than waiting until they die. And I want to bring on an expert in the next couple of weeks who will talk about equity release. He's a specialist in equity release, and we'll go into more detail on that and the rates and how it works and the type of lenders involved. It's a big market at the moment. So it's something the market is growing. There's multi-billion pounds of loans going through equity release, and I think that is artificially keeping the property market up. One of my readers pointed out to me that, yeah, property prices might be going up, but a lot of properties are not selling in parts of the country, properties with cladding problems, properties in areas that don't sell very often. And he said they don't come on the figure, so they're under the radar, which is true. They are under the radar, because if they're not sold, they're not appearing on the land registry figures as sold prices. But we have got some interesting properties through my agency, Open House, on our online auction system, where you can bid at any time. You don't have to wait for the auction date, register, put a credit card down. You can bid for those properties right now, and your bid could be accepted even before the auction date. Frequently happens. And we've got houses starting at around £30,000, £36,000 here. There's one even cheaper the other day. 2-bed house in the northeast. There's a 4-bed buy-to-let rented house with a good yield. Some of these houses are yielding 12 and 14%, which you'll never get in London. You're going to get 3 and 4% down in London. Some of these properties are yielding, certainly more than 10%, 10 to 14%, even after charges. So have a look at that. Have a look at our Facebook page, which is Facebook. I'll put a link up to it, but it's a estate agent. It's Watford and Elstree, and we've got properties all over the country. I'll put a link up to that. So have a look at that. Now, I apologise for my voice today. I'm not feeling 100%. I'm feeling a bit under the weather, but hopefully I'll be back to normal next week. So have a great weekend wherever you are, and enjoy the weather if you're in the UK, and I'll speak to you again soon. Bye for now.